Hi, I'm Prosper Jonican, former hedge fund manager of an event-driven fund, and now the founder of TradeTonic. TradeTonic is an institutional-grade research platform for serious options traders. We have over 8 different quant models baked into the platform with over 32 macroeconomic indicators as well. Today in this video, I'm going to cover the macro regime, which is one of the key features of the platform. So, to get to TradeTonic, you go to tradetonic.app, as you see here in the URL box, and then we click Login. Okay, once we're on the platform, and once you've created an account with TradeTonic, you'll be able to download the desktop app to your computer as well. And here in a second, we'll see the install button will pop up soon. Okay, now that we're on the dashboard and we're within the TradeTonic app, you can also download the app to your desktop by clicking this button here, Install App. That way, you don't have to use the browser. You can just use the cache from your computer to store any data that you need. The first thing we'll see here is the dashboard, and the dashboard video was in the previous video, so be sure to go and watch that, where I cover all of the features that are baked into the dashboard. In this video, we're really going to cover the macro regime, right? So in this particular part of the platform itself, like I mentioned to you, we have over 32 macroeconomic indicators that are baked into our decision-making process. So as a fund manager, when I manage my fund, one of my theses and one of my beliefs when it came to managing money for institutions and for high net worth individuals was I needed to make sure I had a really good understanding of where we were in the cycles, whether that was a credit cycle, whether that was a macroeconomic cycle, whether that was in the yield curve or interest rate cycle. All of those different cycles plays a part in how I would look at different positions and how to structure the portfolio to look and see what's coming around the corner, to be aware of any opportunities, and most importantly, to be able to find idiosyncratic opportunities that worked irrespective of what was happening in the overall economy. One of the key features of TradeTonic is this macro regime. No other platforms out there have a macro regime baked into their platform. Now, some other options platforms give you the option to choose through hundreds of different stock option opportunities that you can trade. Some of them just go really, really heavy on the gamma exposure. But TradeTonic really provides you with one platform that not only gives you the macro regime, gives you the math and the quant behind pricing the options correctly, but it also gives you the strategies that you can implement and that you can trade right away. And you will see that later in this video and in other videos to come. So we're here on the macro environment part of the dashboard. And as you can see, we're in an environment where close to reflation, but slightly risk on, right? Growth and inflation are both rising, typically early cycle or stimulus driven. Nominal assets outperform, the curve steepens, and cycles lead. Okay, so we see here we're in a reflation stage, late part of the cycle, and the VIX or the volatility index is actually relatively low compared to what it could be if it were usually high. Actually, around 15 or 16 in the VIX is about average. This is something I like to look at when looking at the pricing of options, right? So whenever volatility is up, then we know premium is up. We know the price of the underlying option itself is just going to be a little bit higher because you're baking in that volatility, right? So if we kind of go here to some macro details, let's dive in. Here are some of the just a few of the macro inputs that are baked into the quant models that we have here at TradeTonic. We're looking at the the 2s and 10 yield curve, right? We're looking at the spread between the 2-year and the 10-year yield. If you're a serious options trader, then you know how important that really is. We want to make sure that we're understanding if spreads are widening or tightening. That'll give us an idea of if we're on a risk on or risk off environment. We also want to know if the yield curve is normal or if it's inverted, right? If it's inverted, that tells us something. If it's normal, it tells us something as well. Another thing that we like to look at is high yield credit spreads. Again, looking at interest rates. Are high yield spreads widening relative to the underlying treasury or relative to other corporate bonds that are trading out there? What is the financial conditions? Now, if you notice here, within the box, it also gives you a sentiment, okay? So we're seeing rising financial conditions. That could be a headwind, okay? ISM orders that come in, this is about neutral. This is about average. Usually when we see ISM orders below 50 or above 50, that's when we really start to kind of get an idea of where things are going. Initial jobless claims is another macro factor that we bake into our model. The dollar, right? Commodities, real yields, policy expectations with regards to FOMC and the Fed, volatility index, and just the overall breadth of the equity market. Another thing that's baked into the quant lab or into TradeTonic's quant lab that we see here is the growth and inflation matrix. Where are we in the quadrant with regards to inflation, deflation, stagflation, or Goldilocks period, right? And so right now, based on all of the macro factors that are based into the model, over the 32 macro factors that are baked into the model, we see here that we are in the top upper right quadrant, near reflation. The probability of our landscape of us being in this late cycle phase is around 61%. One thing I want to point out here is throughout the TradeTonic platform, you will see a lot of numerical factors here. All of these numbers and all of these factors are based on heavily quantitative math. My background is a master's in finance with strong math suit. And so when we get into the how to price the options, we have over 4 different pricing models that are used to price the options. We are using the binomial option pricing model, the Black-Scholes option pricing model, the Heston option pricing model, and then we're also using the Monte Carlo or volatility option pricing model as well. Now, getting back to the macro factor, some regime implications. What does this backdrop mean for positioning? So kind of going back to what I was saying earlier, as a fund manager and for you as an options trader and you're managing your portfolio, we don't look at things in a silo. A lot of the platforms out there just kind of advise, hey, trade these options on NVIDIA, or execute this vertical on Apple, or do this statistical arbitrage trade on Microsoft and the SPYs. What we like to say is we look at the macro features and we work our way down, right? So we start from a macro standpoint and we say, okay, what does this mean for us in the backdrop? For equities, okay, it favors low beta and defined risk structures. For rates, the front end is elevated, the curve is flat or inverted, recession pricing is building, right? For credit, they could begin widening from tights and can reduce the high yield beta. Commodities become demand sensitive and volatility and options become complacent. So we can favor hedges, collars, put spreads over the naked gamma trades. Here, we start to explain the entire playbook itself. These are some of the strategies that fit well with a late cycle tightening playbook. Some collars, protective puts, and bear put spreads. Throughout the platform, we give you clear instructions on the best way to deploy your capital. If you're managing money for yourself, or you're managing money for other people, Or if you're just a serious trader and you just love trading options, this gives you all the information and the tools that you need to make very, very highly quantitative, informed decisions. So let's dive into why the protective put works. If we click here, this goes into our education form of the page, of the platform, and we explain to you what a protective put is and why it works. All right? So a protective put is a married put that combines a long stock with a long put. Typically out of the money, the put sets a floor on losses below the strike while you keep the full upside on the shares. You pay the premium for owning the put and the cost of the defined downside. It is the cleanest hedge when you want to stay long but fear near-term drawdown risk. Also, if you want more information on what this means and how this applies to the strategy, you can find that here. Here's some examples of how it works. You buy a put on NVIDIA at 130 strike. You long the shares. You can buy the put. Costs you $290 per share. Gives you the floor and the amount of money that you have at risk while protecting your long position in the stock itself. When to use it. You own the stock and fear near-term downside, but want to keep the upside exposure. You can use it ahead of earnings and macro events. If your portfolio is overweight in equities and you need to have some hedging or protection. Now, mind you, this is just one of the strategies that we have here. We have over 39 strategies in our playbook here. So all of our strategies that really start from a macro regime are baked in here. We have defined risk, directional strategies, volatility strategies, even more advanced strategies, some arbitrage strategies, and some quant-based strategies, all at different levels. So let's say you're a beginner and you have some strategies here. This will tell you exactly what you can trade and how you can trade them, and also give you the education behind that. So I will spend more on the strategies of the platform later, but right now we're still focusing on the macro regime. So if we kind of go back here and we also look through some other strategies that could fit, a delta neutral hedge. Again, another strategy that you can play in the current regime that we're in. Now, mind you, it doesn't restrict you to just using one particular strategy. One of the core features of the platform is the fact that we provide you with top plays that are based on the cycle that we're in, the pricing of the option set itself, and the probability of success. Here, you will see a list of all of the different trades that we say are really, really high probability of working, which is explained by the different stars here, some 4 stars, 5 stars, even 3-star trades. You can dive into those different positions and see why this works for you. It'll give you the max profit and loss, break even, and more importantly, if you wanted to, you can add this particular trade to your paper trading portfolio, which we will show in a different video. So this video today just really wraps up the macro regime and how important it is within the TradeTonic platform. This is what differentiates TradeTonic from all other platforms. No other platform out there will provide you with the macro backdrop and the macro landscape of how you can make decisions based on where we are in the cycles, which is extremely important. Again, this is what hedge fund managers are looking at. This is what institutions are looking at. This is how they manage money. And as a retail investor or an options trader, it's good for you to kind of have all of these things in one place, in one platform, where you can make informed decisions. So go ahead, check out the other videos that we have on our page, sign up for TradeTonic, and we'll see you in the next video.